Every single year, business owners hand the government way more money than they're required to legally. Not because they're doing anything wrong, just because nobody's shown them the right moves to make. After 28 years with business owners at the $750,000 to multi-million-dollar level, I've seen the same patterns with hundreds of clients. The ones quietly keeping the most are doing three very specific things. The second one stops people cold. Stay with me for that. And a quick note before we get started, everything here is for educational purposes only, not financial, tax, or legal advice. Please work with a qualified professional before making any decisions. Here's a question we're sitting with. Who is looking at your compensation, your retirement plan, your distributions, and your tax timing all at once? Not who handles each one, who's looking at all of it together. Most business owners can't answer that question, not because they haven't built a good team, because the question was never asked. A 1.2 million practice owner I work with had a CPA, had an investment advisor, and an attorney. When I asked him that question, he went quiet. Then he said, I assumed somebody was. 3 professionals, 0 coordination, a gap running silently for years. So at the end of this video, I'll give you 5 question checklists to audit your own setup. Let's get into it. S-Corp compensation. Think about the salary you're paying yourself as an S-Corp owner. When was it set up, and when did it last get reviewed to ensure it still made sense? For most S-Corp owners, the CPA sets it at formation and no one really touches it. If your revenue has grown since, and for most owners watching this it has, that original number may be costing you every payroll cycle without anyone flagging it. Now, the IRS does require S-Corp owners to pay themselves a reasonable salary before taking any distributions. What most owners don't know is there's a meaningful range inside of reasonable, and where you land affects self-employment tax every single year. So let's take a hypothetical situation. An owner with $400,000 in net profit at a $250,000 salary versus $150,000, both potentially defensible depending on the role in the industry you're in. They may see an annual self-employment tax difference of $15,000 in some cases, just from where the number sits. It runs in both directions. Too low draws IRS scrutiny. Never adjusting upward, it may be costing you more than it needs to. Either way, it's worth a review. The S-Corp salary isn't a payroll number. It's one of the most significant annual tax decisions in your business. And most owners have never actually made it. It was made for them once and left alone. The next one is where most people stop and start doing math. So let's talk about stacking retirement plans. I asked most business owners what retirement plan they're using, and you'll hear solo 401k or SEP IRA. Maxed out, done. And for many owners at the $400,000 net income level, particularly 45 and older, the real ceiling is significantly higher than that. The owners quietly building the most wealth outside their business aren't doing anything exotic. They've asked one question: is this actually the most I can put away? And they found out the answer was no. The ones who never asked, still maxing a solo 401k, still wondering why the tax bill keeps growing. What most people don't know, a cash balance plan is the defined benefit plan that layers on top of your existing 401k. Contributions actuarially driven. They scale with your age. For owners in their late 40s and 50s, annual contributions can reach $200,000 to $300,000 or more. There's owners out there combining a 401k and a cash balance plan and putting upwards of $300,000 a year in tax advantage accounts. Most business owners that I talk to, they just simply don't know these types of numbers are available to them. Not because it's hidden, but because no one's helped ask the questions. So hypothetically, an owner contributing $250,000 at a 37% effective rate may be looking at approximately $92,500 in deferred tax, not over a decade, in 1 year. Has anyone ever ran the analysis for you? These plans work best for consistently profitable businesses, $400,000 to $500,000 or more in net income, with owners 45 and up who can commit to multiple year funding. Now, your CPA and the qualified actuary would be part of any real analysis done for you. Most CPAs don't surface this because it requires an actuary to administer. The question isn't whether you're maxing your 401k plan, it's whether the plan you max was the right one for you or just the one someone set up and no one revisited. So quick question, has your advisor or your CPA ever brought up a cash balance plan with you? Type in yes or no in the comments. I read all of them. And if this has you thinking about your own retirement setup and you have questions that are better for a conversation than a comment below, there's a link below to set up a 20-minute chat. Let's keep going. Let's get into quarterly tax planning. Typically, when do you find out what you owe in taxes? March or April. By then, every decision that could have reduced that number is already off the table. So what's happening in that meeting? It's documenting what has occurred. The decisions that actually move the number had to happen before December 31st. For most business owners, that conversation never happened because no one was assigned to ask the questions during the year. Tax planning happens while there's still something to shape. A structured quarterly review looks at where your income is tracking, whether estimated payments are calibrated properly, and which windows are closing before the year end. Retirement plan elections, bonus and distribution timing, Section 179 depreciation, income deferral on year-end deals, tax loss harvesting. Your CPA handles the code. The question is whether any of these have been reviewed against your current year's projected tax return. For most owners, that conversation doesn't happen until it's way too late. You probably have a CPA for the return, an investment person for the portfolio, but no one owns the middle. No one's asking whether the portfolio, tax activity, the business income, and the retirement contributions are all adding up to the right picture for this year. It's a structural gap, the kind that doesn't show up on any individual statement but costs real money across the full picture. The owners who are consistently ahead on taxes aren't running more complex strategies. They're reviewing the numbers in Q1, Q2, Q3, not finding out in April what they should have shaped in October. That's the whole difference. If the first time you see your tax return is when it's ready, you're not doing tax planning, you're doing tax reporting. Planning and reporting are not the same, and only one of them could actually change your outcome. So the thread through all three of these is the same. They live in the gap between your existing professionals. Your CPA owns the return, your investment person owns the portfolio return, the compensation review, the retirement plan ceiling, the in-year planning windows, those fall through unless someone is specifically looking at them. That's the role I play. I'm a business owner, I'm a certified financial planner. Our planning runs on quarterly sprints built around 3 pillars, which is actually where the name TriBox comes from. We help clients think through cash, we help them protect and grow what they've built, and when those two are in place, they can approach investment decisions from a position of clarity rather than pressure. Cash, protection, and investments. We're not CPAs, we're not attorneys, but we make sure those relationships are coordinated so the tax plan, the legal structure, and the financial plan are all working from the same picture. Here's a question worth sitting with. When was the last time someone looked at your compensation structure as a planning decision, not a payroll number? Is the retirement plan you've maxed out the highest ceiling available to you? Or just the one nobody revisited? Who on your team is looking at your full picture in Q2 and Q3 while there's still time to do something? If those questions don't have a clear answer, that's not a problem with your CPA or your advisor. It's a gap that you have in your plans. And before I let you go, here's your checklist. Screenshot it. And speaking of questions, if this sparked any and you want to connect about them, reach out using the link below. Set up a 20-minute chat. I'm here to help, whether it makes sense for us to work together or not. I enjoy these conversations and I appreciate you watching. And if you want to go deeper on how entity structure affects not just taxes, but your full financial picture, watch my video on the 8 financial assets business owners overlook. The link is somewhere here. I'm John Rojas. I'll see you on the next one.